This is King World News. I'm Eric King, and you're about to hear a very powerful interview with David Tice. Remember to go to our homepage at www.kingworldnews.com for more interviews, where this week we have a couple of absolutely outstanding interviews with John Hathaway, who put out an amazing year-end piece, as well as Bill Fleckenstein of Fleckenstein Capital. And there will be a special year-end interview with the legendary Jim Sinclair, which should be pre-released this coming Monday. Joining us now is David Tice from the Federated Prudent Bear Fund. David, thank you for joining us here at the end of the year on King World News. I want to start off first by asking you about the interview I just did with John Williams. He kind of put out a blockbuster piece, and I wanted to get your commentary on a few things that he said, starting off with this one by John. Quote, "We had a deficit in 2008 of $5.1 trillion. And I'm figuring a deficit of $8.8 trillion in the year just closed in 2009. Putting that into perspective, if the government taxed 100% of everyone's income and corporate profits, they'd still be in deficit," end quote. What are your thoughts on that, David?
Oh, I couldn't agree with John more. John is a great analyst. I've met him before. We are in dire straits on the fiscal side, and Pete Peterson and David Walker, who is the ex-comptroller of the currency, have been railing about the fiscal situation for some time. And under Obama and Geithner, we've made the situation far worse with the stimulus package, this Keynesian response. And we are in deep, deep trouble because of our spending, and it's becoming irreversible.
Here's another line from that interview from John. If they cut out all government spending, shy of Medicare and Social Security, they'd still be in deficit. So we're at a circumstance right now where the government has $75 trillion in total debt, net present value, unfunded liabilities, 5 times GDP. No way it can possibly pay it off, end quote. What are your thoughts as you hear that analysis from John?
It's truly scary, and certainly some things can be done with the unfunded liabilities for health care where some adjustments can be made. Now, that's not going to make the citizenry happy. However, it took us 211 years to get to about $6 trillion of debt. Now we're at $12 trillion, and the GAO is estimating another $13 trillion by 2019, or $25 trillion of explicit debt. And if interest rates are at 5%, that's $1.25 trillion. At 10%, $2.5 trillion, which is more than total revenue for 2009. And certainly I'm very, very worried about these health care obligations, Social Security obligations, because Congress has not seen fit to be able to deal with these problems.
And finally from John, quote, "Left to its own devices, we could have gone a little further. But as the crisis broke, the government took action to spend a lot of money. The Fed flooded the system with a lot of liquidity, and it has accelerated the process. The ultimate solution to the debt problem is paying it off by printing the money. And what they've done is they've accelerated the process. We can see that the crisis in the monetary system breaking in the year ahead, no more than 5 years down the road. And with that, you see the beginning of a hyperinflation. And with a hyperinflation, I'm talking something where the dollar becomes virtually worthless, where the largest note in circulation, a $100 bill, becomes worth more as functional toilet paper than as currency," end quote. What are your thoughts on that, David? Because that's pretty powerful stuff.
Well, that's a very strong statement. I wish I was a refined student of monetary history to be able to make that judgment. I certainly do believe that the U.S. dollar is going to decline significantly. It could certainly decline 30 on the dollar index. If it gets completely worthless, I think a lot depends on what happens in the future as well, as far as how much printing goes on. We've seen a massive amount of printing so far. We are setting ourselves up for a dire situation where we're likely to have to continue to print to be able to pay the interest and feed people as more and more people go out of work. I do not discount it getting to that level.
Let me ask you about the response to this, which John is really addressing there. And now let's move on to the questions that I have for you, David. How do you feel about the Keynesian response, right, which is to just spend our way out of this and use stimulus and basically just spend our way out of this mess. I mean, that's no solution. And I know you're an Austrian economist, but can you just address that, please?
Well, I'm a big fan of Tom Woods, who has written the book Meltdown, and he's a senior scholar at the Mises Institute. He's a big believer of the Austrian School of Economics. Also like to point out a recent quote from Guido Tremonti, who's Italy's finance minister. If the problem is an excess of debt, the cure is not adding more debt, whether that debt is public or private. Now, that's the problem. Is in this Keynesian response, we're essentially substituting because we're backing up private debt with public debt. Now, I'm reminded by a recent quote this was an 2002 quote by Bob McTeer from the Dallas Fed, and it really exemplifies the Keynesian response. Everything will be all right if we all hold hands and buy a new SUV. Now, you think about that and how ridiculous that is, but essentially what Greenspan did is he substituted a housing bubble when the internet bubble and the telecom bubble burst back in 2001 and 2002. And he put the country in far worse condition. This Keynesian response is going to essentially put the entire country's financial standing at risk. Therefore, the entire creditworthiness of the U.S. government will come under question. And that is a very, very big problem. I'd like to point out what happened back in 1920 and 1921 when we had a significant depression, and Tom Woods points this out in his book, Meltdown. In 20 and 21, we went to significant unemployment. GDP was down about 17%. Unemployment had reached 12%. And what happened was what Harding did. Harding ended up cutting the budget deficit by nearly half. Tax rates were slashed, and national debt was reduced by a third. The Fed did not really do anything on the monetary policy front to fight the contraction. However, recovery came back. 1922, unemployment had fallen to 6.7% and had fallen to 2.4% by 1923. Now, the country definitely had an advantage then because a lot of industrial capacity had been wiped out after World War I. However, still, the response was to cut spending, cut taxes, and unemployment fell dramatically. I'd also like to contrast what was said in 1920 inaugural speech from Warren Harding. Let us call to all the people for thrift and economy, for denial and sacrifice if need be, for a nationwide drive against extravagance and luxury, to a recommittal to the simplicity of living, to that prudent and normal plan of life, which is the health of the republic. Now contrast that with everything will be all right if you hold hands and buy a new SUV.
Right.
And ask most Americans if they don't think that makes more common sense if you get into fiscal difficulty.
Because you touched on this briefly, David, let me ask you about the coming funding crisis that you say is going to happen in the United States, because Bill Fleckenstein and others also are talking about this. Can you just address that, because you sort of touched on it briefly?
Well, recent numbers just came out with the Treasury International Capital data for October. This is the Tice data, which shows the net foreign purchases of long-term securities. And actually, the recent data for October show that foreign holdings of dollar-denominated U.S. securities decreased by $38.3 billion. So what we have is we have a case where the U.S. must roll over trillions of dollars of debt. They must issue a projected $1.8 billion increase in debt. I've seen estimates of up to $3 trillion. Potentially it's more than that for 2010.